Welcome to Breaking News to Trading Moves. We are looking at a specific event in the markets, stripping away the noise and getting right down to the mechanics of who wins and who loses.
Exactly. It's about the specific transactional implications. We're looking at order flow, sector rotations, and valuation adjustments, not the broad narratives.
Okay, so the headline of it we're focusing on is the public debut of the crypto custodian BitGo. The company has officially priced its U.S. initial public offering.
And the number is out.
We're looking at a price of $18 per share.
$18. That's the headline number, and it's an important one.
And to put some weight behind that, this pricing raises approximately $212.8 million in fresh capital for the company.
A pretty substantial war chest.
When you crunch those numbers, it values BitGo at roughly $2.08 billion.
So call it a $2 billion valuation for a custody play. That's the baseline we're working with here.
And for anyone watching their terminals, the stock is expected to begin trading on the New York Stock Exchange. The ticker symbol, and you'll want to add this to your watch list, is BTGO. That's BTTGO.
Yeah, before we get into the specific winners and losers, we have to look at the signal this pricing sends. The critical detail here isn't just the $18 price tag.
It's the context,
It's
right?
absolutely the context. BitGo priced above its marketed range.
Which usually means the order book was hot. They had more people wanting to buy than shares available at the initial price they were floating.
Precisely. The demand outstripped the supply at that level. It's a classic risk-on signal for the crypto equity sector. I mean, we're operating in an environment where regulatory uncertainty is still a major talking point.
It's the main talking point for sure.
There are still gray areas, lots of them. And yet you have public market investors, the big funds, stepping up and saying, we want this exposure. And not only that, we're willing to pay a premium for it.
So despite all the headlines about regulation or market volatility, the institutional appetite is clearly there. It's not just a retail phenomenon.
It indicates real demand. It validates the thesis that these large investors are looking for infrastructure plays. They're not just speculating on tokens, they want to own the pipes.
The picks and shovels?
Always. And that brings us to the core of our discussion. When a company like BitGo enters the public arena with this kind of valuation and, more importantly, this kind of capital, it mechanically alters the landscape for other stocks.
Okay, let's break that down. We're going to look at the winners first. Let's start with the folks who actually built the deal, the capital markets underwriters.
This is the first derivative trade. The most immediate beneficiaries are the banks that facilitate the whole transaction.
We're talking about the heavy hitters here. Goldman Sachs Group, ticker GS.
And Citigroup, ticker C.
So walk us through the logic. Why do Goldman and Citi win when BitGo prices at $18? The fees are the obvious part.
The fees are the obvious part, yes. They get a percentage of that $212 million raised. That's direct revenue, straight to the bottom line. But the secondary effect is arguably more valuable for them in the long run.
You're talking about the pipeline, the future deal.
Exactly. The IPO window is a fickle thing. You can slam shut in a heartbeat based on market sentiment. When a deal like BitGo gets done, and gets done well, I mean, pricing above range, it acts as a proof of concept.
It sends a signal to other private companies.
It signals to every other private fintech or crypto infrastructure company that's been waiting on the sidelines that the water is warm.
So if you're a banker at Goldman, ticker GAS, you're on the phone this morning, you're using this BitGo deal as your case study, calling up your other clients and saying, look, we can get this done for you too. The market is open.
It creates a flywheel. More successful IPOs lead to more mandates. More mandates lead to more underwriting fees, more trading commissions, and a stronger advisory pipeline for the next 2 or 3 quarters.
So Goldman Sachs and Citigroup are essentially betting that BitGo is the icebreaker. If this trade holds up in the secondary market, they're going to see an influx of business from that backlog of companies that have been waiting to go public.
It's about the optics as much as it is about the fee on this one deal.
Yeah.
Successful deals just breed more deals. It's the nature of that business.
And for a bank like Citigroup, ticker C, which has a massive institutional client base, being a book runner on a successful crypto infrastructure deal is a major credential.
It absolutely is. It shows they can navigate the regulatory nuance, which is not trivial in this space, and get the deal across the finish line. In a competitive environment for mandates, that's a key advantage. It says, we know how to do this.
Okay, so we need to keep an eye on GS and C as the primary beneficiaries of the capital markets activity itself. But let's move down the stack. Once the stock is actually trading, it has to live somewhere.
Right.
That brings us to our next category of winners, exchanges, and market infrastructure.
This is a volume and data story. At the core, that's what it is. And we're looking at Intercontinental Exchange, ticker ICE.
And NASDAQ, ticker NDAQ.
Correct.
Now, the BitGo connection to ICE is pretty direct. It's listing on the NYSE, the New York Stock Exchange, which is owned by Intercontinental Exchange, ticker ICE. So they get the listing fee. That's clear.
They do, and that's nice recurring revenue for them. But again, we have to look a little broader. A healthier IPO calendar boosts listing activity across the board. If BitGo trades well on the NYSE, it encourages other issuers to list there, or on NASDAQ, it just gets the whole machine moving again.
But you said it's a data story. What does that mean exactly?
Think about the downstream effects. Every time a new, volatile, high-profile asset like BTGO is listed, it creates a massive amount of demand for market data.
Traders need the feed, the real-time information.
Hedge funds need the feed. Algorithmic traders need the level 2 data, the order book data. The exchanges, both ICE and NASDAQ, monetize that data. It's an incredibly high-margin business for them. A new active stock is a new fire hose of data they can sell.
And it also boosts secondary trading volumes, I assume. The more instruments to trade, the more trading happens.
Exactly. The more high-quality liquid assets you have on your venue, the more overall liquidity enters that venue. Market makers show up, high-frequency traders show up, and that creates tighter spreads, which attracts even more volume. It's another kind of flywheel.
And NASDAQ, ticker NDAQ, even if they didn't win this specific listing, they still benefit from the sector getting hot again.
A rising tide lifts all boats in the exchange business. I mean, if the crypto equity sector becomes a popular place to trade again, trading volumes across the entire market structure stack increase. Volatility is the exchange's best friend.
And a new IPO, especially in a volatile sector, is a new source of that.
BitGo is adding a new, distinct flavor of volatility to the market. That is a net positive for the venue operators, ICE and NDAQ, no question.
Okay, so we've got the banks building the deal and the exchanges hosting the deal. Let's move to the people who are actually buying it, or at least paying attention to it. Segment 2 is all about retail engagement.
Right. This is where we look at the brokerage layer, the on-ramps.
And we're talking about Robinhood Markets, ticker HOOD, maybe your traditional player, like Charles Schwab, ticker SCHW.
The logic here is centered on what you could call the attention economy. High-profile crypto listings are, in and of themselves, marketing events. They are very different from, say, a standard industrial IPO.
Nobody's getting excited on Reddit about a ball-bearing company going public.
Exactly. When a crypto name lists, it tends to dominate financial Twitter, Reddit, and the general news cycle for a day or two.
And that buzz brings people into the app.
It brings people into the app. It drives what they call app activity. And this is key. Even if a retail user doesn't end up buying BTGO specifically, the fact that they logged into their Robinhood account to check the price means they're active, they're engaged.
And once they're in the app, they might do something else.
They might see BTGO, decide it's too expensive or they don't understand it, and then they see an alert for another stock and buy that instead, or maybe they buy some crypto directly. The catalyst for all that potential activity is the single login prompted by the IPO buzz.
It wakes up the dormant accounts. We saw this with previous major listings. The buzz just creates volume across the board.
It does. And for a company like Robinhood, ticker HOOD, which is so heavily indexed towards retail sentiment and crypto trading volumes, a new ticker symbol is fresh inventory. It's something new to display in the trending lists, something new to send push notifications about.
And what about Charles Schwab, ticker SCHW? That seems like a different kind of investor.
It is, but the effect is still there. Schwab has a massive base of slightly more conservative, maybe wealthier retail investors. For them, BitGo represents a way to access the crypto theme through a regulated, familiar equity structure.
Instead of opening a wallet on a crypto exchange and dealing with private keys.
Exactly. It's a much lower friction way to get exposure. So Schwab sees increased trade tickets for BTGO. More tickets mean more payment for order flow or just, more general engagement with their platform, which keeps clients in their ecosystem.
So HOOD and SCHW are the downstream winners of the retail attention that a name like BitGo can generate.
Correct. For them, it's a pure catalyst for engagement.
All right. We've covered the winners pretty thoroughly. The banks, the exchanges, the brokers. Now, we have to look at the other side of the trade. Markets are efficient, and if someone is winning, someone else is probably feeling some pressure.
There's always another side to it.
Let's talk about the losers, specifically in segment 3, the direct competition.
This is the most direct impact, the clearest cause and effect. We're looking at institutional crypto custody and prime competitors.
And the names that come to mind here are Coinbase Global, ticker COIN,
For sure.
and then the traditional finance giants trying to get into this space, like Bank of New York Mellon, ticker BK, and State Street, ticker STT.
The logic is very straightforward. BitGo just raised over $212 million. They are now a public company with a transparent balance sheet, audited financials, and a war chest of cash.
And in the custody business, trust and capital are everything. That's the whole product.
That is the product. You are selling safety and security. Before this IPO, BitGo was a major player, but it was a private company. Now they have the public company stamp of approval, and that really matters to institutional allocators.
A pension fund's due diligence team probably sleeps better at night.
They absolutely do. If you're a pension fund or a big hedge fund looking for someone to hold your digital assets, you might inherently prefer a public counterparty where you can see their financials every quarter.
So this is a direct threat to Coinbase, ticker COIN.
It is. Coinbase has a very strong, very successful institutional custody business. It's a core revenue driver for them. BitGo is now a better capitalized, more visible competitor coming specifically for that institutional wallet share.
What can they do with that $200 million?
They can use that $212 million to subsidize fees to win clients. They can use it to build out new features, to expand their sales team globally. It just gives them more weapons.
So it intensifies the price war in custody.
It creates margin compression risk for Coinbase. If BitGo comes into a bake-off for a new client and says, we'll undercut Coinbase's fee by 5 basis points, Coinbase has to respond. They can't just let them take the business. That directly impacts their profitability.
Okay, and what about the banks? BNY Mellon, ticker BK, and State Street, ticker STT. These are the titans of traditional custody. They've been trying to make inroads here.
They are the incumbents in the traditional asset world, and they are moving into digital assets. But they move slowly. It's the nature of these massive organizations. BitGo is a crypto-native firm that now has the capital and the public currency to compete with these banks on their own turf for institutional clients.
It sort of blurs the line between the crypto-native and the TradFi worlds.
It does. I mean, if you're BNY Mellon, ticker BK, your whole pitch is, we are the safe, established, regulated bank. Come to us. BitGo's IPO chips away at that argument.
How so?
BitGo can now go to those same clients and say, we are also a regulated, public, transparent company, but we actually understand the underlying technology much better than the banks do because we've been doing this for a decade.
So BK and STT might lose market share on the digital asset side specifically because the specialist just got a lot stronger and more credible.
Exactly. The specialist is scaling up. The threat for the big banks is that BitGo becomes the State Street of crypto before State Street can actually become the State Street of crypto.
That's a crucial distinction. Okay, let's move to segment 4. This one is a bit more nuanced. We're talking about sentiment and flow rotation.
This is about how portfolio managers allocate capital. It's the share of wallet argument on a macro level.
The first category here is what we can call the fintech crypto wallet and payments narratives.
And here we're looking at companies like Block, ticker SQ, and PayPal, ticker PYPL.
These are companies that do a lot of things, but crypto has been an important part of their story, especially for their stock price.
Right. Block has the Cash App and all their Bitcoin initiatives. PayPal has their crypto checkout features and their stablecoin work. For a long time, if a public equity investor wanted safe exposure to the crypto theme without buying Bitcoin directly, they bought SQ or PYPL.
They were the go-to proxies for the theme.
But they're what you'd call diluted proxies. You're buying a massive payments company that happens to have some crypto exposure. BitGo, on the other hand, is a pure play. It's infrastructure. It's custody. It is 100% focused on digital assets.
So we're talking about something called flow rotation risk.
Precisely. Let's put ourselves in the shoes of a portfolio manager. Let's say I run a tech fund and I have 5% of my fund allocated to a basket I call fintech and crypto.
Okay.
And in that basket, I own some Block and some PayPal. Now, suddenly, a pure infrastructure play like BTGO becomes available. I might look at my portfolio and say, you know what? I can refine my exposure here.
So you sell some of the generalists to buy the specialist.
You sell some of your Block, ticker SQ, or PayPal, ticker PYPL, to free up capital to buy BitGo. You're swapping a diluted play for a concentrated one. This can temporarily dilute the multiples for those broader fintech names.
Because they lose that scarcity premium. They're not the only game in town anymore. for public market crypto exposure.
That's the perfect way to put it. They lose the scarcity premium of being one of the few ways to play the theme in the public equity market.
So SQ and PYPL could see some selling pressure just from investors rebalancing their portfolios to make room for the new kid on the block.
It's not that their underlying business is suddenly worse. It's just that the menu of options for investors has improved and expanded.
Finally, let's touch on the high beta crypto proxies.
This is where it gets very technical, and it's all about valuation and how themes are priced by the market. We're talking about names like MicroStrategy, ticker MSTR.
And a miner like Marathon Digital Holdings, ticker MARA.
Exactly. MicroStrategy at this point is effectively a leveraged Bitcoin holding company, and Marathon is a miner. So its fortunes are tied directly to the price of Bitcoin and mining economics.
And for a while, these were the trades to make if you wanted aggressive exposure.
They traded with a massive premium to their underlying assets at times because, again, there was a scarcity of public crypto equities. If you wanted high-octane exposure to the theme, you bought MSTR or MARA.
So how does a company like BitGo reprice this entire theme?
BitGo offers infrastructure exposure rather than direct commodity price exposure, and institutional investors often prefer infrastructure. It's the classic picks and shovels thesis we talked about earlier.
You're investing in the tools that enabled the gold rush rather than betting on the price of gold itself.
Exactly. And if large institutions decide that they want to be in the crypto equity space, they might look at MicroStrategy and say, that's just too volatile for us. It's too dependent on the spot price of a single asset.
Whereas BitGo is different.
They look at BitGo and say, okay, this is a service business with recurring revenue, with long-term contracts. It looks and feels more like a traditional software or financial services investment.
Which is much more palatable to a conservative investment committee.
Much more. So we could see flows being pulled away from the proxy trades like MSTR and MARA. The capital that was, for lack of a better term, hiding in those names because there was nowhere else to go, might now migrate over to BTGO.
It forces a re-rating of the whole group.
It does. If the market decides that crypto infrastructure as a category should trade at, say, 15 times earnings, but the crypto proxies are trading at 30 times, that gap might close. And usually it closes by the expensive stuff coming down, not the other way around.
So MSTR and MARA are at risk of a valuation check as the sector matures and adds more diverse types of companies for investors to choose from.
It creates a more mature, but also a more competitive landscape for capital flows. The bar gets higher.
Okay, so to bring this all back to the center, the headline is BitGo, ticker BTGO, pricing its IPO at $18 per share. That's the stone dropping in the pond.
And the mechanical moves, the ripples, are what we just outlined.
Let's do a quick recap. On the winner side, we have the underwriters, Goldman Sachs, GS, and CitiC, banking the fees, and, maybe more importantly, the positive optics for future deals. We have the exchanges, ICE, and NASDAQ NDAQ, banking on the increased volume and the demand for high-margin data.
Yes.
And we have the retail brokers, Robinhood, HOD, and Schwab, SCHW, benefiting from the attention and the user engagement that a big listing creates.
A clear chain of custody for the win column.
And on the loser side, or at least those feeling the pressure, we have the direct competitors, Coinbase, COAN, BNY Mellon, BK, and State Street, STT, now facing a better funded and more credible rival.
The competitive landscape just got tougher.
We have the broader fintechs, Block, SQ, and PayPal, PYPL, facing rotation risk as investors look for more pure play exposure.
A potential headwind for their multiples.
And finally, we have the high beta proxies, MicroStrategy, MSTR, and Marathon, MARA, facing a potential re-rating of what crypto exposure is actually worth in the public markets.
It's a classic case of new supply changing the demand dynamics for everyone else in the ecosystem.
Now, before we let you go, we need to be very clear. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author and our analysis of the market mechanics.
Always do your own diligence. We are discussing the setup, the mechanics of the market, not predicting the outcome.
But the thought we want to leave you with is about the mechanical nature of these moves. When you see a headline like an $18 IPO, it's easy to just think about that one company. But the market is an interconnected machine.
It really is.
One price point for BitGo resets the inputs for a dozen other algorithms and portfolio models across Wall Street.
It's not emotional. It's math. The winners and losers that we just talked about aren't chosen because the market likes them or hates them. They're chosen because the flow of capital has to go somewhere, and a new, large variable just entered the equation.
Watch the flows, watch the tickers. Thanks for listening to Breaking News to Trading Moves.
See you on the next trade.